We have many articles over the last few days discussing how big oil enters 2024 in a very strong position, how they look to be undervalued, some of the best energy stocks to buy for 2024, and they do believe that those with very strong balance sheets have a lot to gain over the next 12 months. And we can see here there are a lot of articles discussing what they believe to be the most undervalued. So in today's episode, we're going to look at 5 of the biggest oil and gas companies to see whether or not they are undervalued, what margin of safety. We're going to look at their dividend safety, looking at some very important financial metrics. And as always, we will run them through our valuation model to get to what we believe to be their intrinsic value, as well as their acceptable buy price given our investor margin of safety. So the first oil and gas company that we are looking at today is BP, Beyond Petroleum. Now this, over the last year, 2023, was up around 2%, very poor considering the S&P 500 was up around 25%. We see it towards the mid to lower point of the 52-week range, and it offers a forward yield of just below 5%. Now, if you've been holding BP over the last 10 years, well, you would be down 26%. And as we can see, it has been coming all the way down since 2014 at around $53. So let's take a look to see whether or not now is the perfect time to buy BP PLC. Dividend safety score 50, it is borderline safe. 100 billion, it is a mega cap company. Now, in terms of the recessionary metrics, well, they maintained the dividend during the last recession. Negative 39% recession sales. Remember, that is below the average growth, as that sits around 12% for the S&P 500 companies, but they still beat the S&P during that period. Negative 45% return versus the S&P's negative 55%. Now, in terms of dividend growth, something that will be common among these oil and gas companies, very minimal growth in this year, 0.1% in November 23, but over the last 5 years, due to COVID, as we did see a lot of these plummet in price, their dividend was cut. BP down 10% on average over the last 5 years, and we can see here from this graph. In terms of dividend growth, well, they have only been increasing their dividend for the last year. Now, in terms of dividend yield theory, it states a company is undervalued when the current yield sits above the 5-year average. So we have a sign here of reasonable valuation. But as always, do bear in mind we don't look at any of these models in isolation, and we'll draw our conclusions towards the end. Forward PE sitting near enough in line, 7.3 versus the 5-year average of 7.7. And when we compare it to the energy sector PE at 11.8, BP does sit considerably lower. Now, in terms of the free cash flow payout, which is what we focus on, earnings is susceptible to manipulation by management through accounting. Personally, I like to see below 60%. For oil producers, some investors do bring it down to 40%. Now, what we can see here is the volatility due to the cyclicality of the oil and gas industry. Although over the last 2 years, it has been very low. 2023 expected 22%, 24 expected 31%. So we should expect to see some nice dividend growth in BP over the next few years. Free cash flow per share, well, negative 18 cents in 2013, 152 in 2022. It has been increasing over the last 10 years, but again, do note it is fairly inconsistent, and 2023 it is expected to drop to around 127. Sales growth, well, 3 to 7% is what we like typically for steady, moderate growth companies. But as I mentioned, due to the cyclicality of the industry, we see a few years of negative growth, followed by years of double-digit growth, and so on and so on. The cycle continues. And what you want to be looking at for these type of cyclical companies is to be buying them when they are out of favor, when they are out of cycle, so you can ride up the price when they become back in favor, back in cycle. Numerically then, 380 billion to the top line in 2013, 240 in 2022. So overall, their top line has been in fact decreasing. Shares outstanding, they do share buybacks. They've also issued shares to investors, so they have diluted your position as a shareholder. 19 billion in 2013, 19 billion in 2022. So we can see the net movement over the last 10 years has been nil. Now, ROIC, 10% or more is what I look at. It gives me faith management are able to effectively allocate their capital. And what we can see, very inconsistent, although 2022 at 29% and 2023 at 30% is positive, gives us faith in management and their way to operate the company effectively. Both operating margin and free cash flow margin should come as no surprise. It is very, very cyclical, very volatile. We do see, however, it doesn't really get to the 12% on the operating side, only 1 year out of the last 10. And with the free cash flow margin, a little better, but still very, very cyclical and very inconsistent. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, remember, shows us two things: balance sheet safety, balance sheet strength essentially, as well as that dividend safety. These are the number of years it would take the company to pay off all of their debt net of cash on hand. And we can see here 2022 very low at 0.31. 2023 it is expected to increase, but still below that 1.5 maximum. So it does give us faith in their dividend safety as well as the general balance sheet strength of the company. Now let's jump into the valuation. As always, regular viewers know we run through every single model: Graham's valuation, multiples, dividend discount, DCF, and the valuation model. For today, we will jump straight into this final tab. And essentially the intrinsic value is the average of these three models, coming to $44.83. Now, as always, if you do enjoy the content values being provided throughout the videos, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So we start off with a margin of safety of 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. At 10% is an acceptable buy up to $40. If we move that to 15%, it is a buy up to $38, and at 20%, it is a buy near enough the current trading price. Now, what do Wall Street believe? Well, they also see some nice upside to the current trading price, as we can see well over 20%. So in conclusion, for BP Beyond Petroleum, we see around a 20% margin of safety based on our estimates and judgments, with Wall Street seeing some very nice gains well over 20% over the next 12 months. We then move on to the second company, the second big oil and gas, which is Exxon Mobil Corporation, down 9% or 8.5% over the last year. They are trading essentially towards the mid to lower end of the 52-week range with a yield of around 3.8%. Now, if you've been holding this over the last 10 years, you would be essentially flat on your investment. Remember, it doesn't include those dividends reinvested, but they are pretty much been trading towards that all-time high of around $120. Dividend safety, it sits at 80, it is safe. 400 billion market cap, it is a mega cap company. Now, when we take a look at those recessionary metrics, well, they've increased the dividend during the last recession, negative 41% recession sales, below the average growth, and they did significantly outperform the S&P with a negative 28% return versus the S&P's negative 55%. Dividend growth, while above inflation, above that 4% that I advocate on the channel to get every single year. Remember, if you're getting less than 4%, which was the average inflation rate over the last 40 years, you are taking a pay cut or losing your purchasing power, whether that's your salary, dividends, or other income-producing assets. Over the last 5 years, 3% per year. Over the last 20 years, 7%. And when we take a look at some phenomenal metrics here, we can see they've been increasing their dividends for the last 40 years or more, 10 years away from becoming a dividend king. And we can see that they have been paying dividends uninterrupted for the last 141 years. Absolutely incredible. Now, when we focus on dividend yield theory, we can see here we have a sign of overvaluation with the current yield sitting essentially below the 5-year average. But as always, we never look at any of these models in isolation and we'll draw our conclusions towards the end. Forward PE telling us a slightly different story, 11.4 sitting below the 5-year average of 12.4. And again, when we compare it to the sector PE, it is pretty much in line with Energy's 11.8. Now, focusing on the free cash flow payout, we see a very similar story to BP, very, very volatile, and we see the last 2 years, however, below that 60% that we look for, 2023 at 39%, 2024 expected 45%, so that dividend does look to be safe for the time being based on the information we have. Free cash flow per share, well, $2.54 in 2013, $30.90 in 2022, it has been increasing over the last 10 years. But again, note the inconsistency. If you've been holding this from 2013 and sold in 2019, it didn't look the greatest, but then we do see that post-COVID jump, but it is again expected to come down in 2023 to 927. Sales growth, again, it is just purely the cyclicality of the industry. We will expect to see this graph for all the oil and gas companies we take a look at today. Negative growth followed by positive growth and so on and so on. And do note 2023, they are expecting to have their top line drop down by around 10% from the prior year. Numerically then, 390 billion in 2013 to 400 in 2022. Now, unlike Beyond Petroleum, we do see 4.42 billion shares outstanding, 4.21 in 2022. They have done share buybacks, returning excess cash to investor pockets. Now, when we focus on the ROIC, remember 10% or more, 11% in 2021, 26% in 2022, 19% in 2023. So that is positive to see. It is a trend I would like them to continue being above that 10%. Again, operating margin, free cash flow margin, not much to say other than the industry, the volatility that we see here. Although the last 2 years have been decent, 2023 expected 15%, again above that 12% minimum we look for, and the same story with regards to the free cash flow margin. Net debt to EBITDA, then we do see that very high, which is a common trend in 2020 through all the oil and gas companies. 2022, 0.2, 2023 expected even lower. This is a company with a phenomenal balance sheet, and we can see that Dividend does look to be safe with that 80 score, as well as seeing their net debt to EBITDA metric. Jumping into their valuation, and as always, if you do want to grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list, do click on that pinned comment below. So let's jump into the margin of safety. As always, we start off with 10% if we believe it hits those three metrics. At 117, it is acceptable buy. At a 15% margin of safety, it buy up to 110. At 20% up to 104. And at 25%, near enough the current trading price. So you are getting between a 20 to 25% margin of safety. In terms of Wall Street and what they see, well, they see around 30% upside over the next 12 months. So they do see this as significantly undervalued and a strong buy. So in conclusion, for Exxon Mobil, we see around a 20 to 25% margin of safety, with Wall Street seeing around 30% upside over the next 12 months. We then move on to stock number 3, oil and gas, and this is one of Warren Buffett's favorite companies that he has been buying, Occidental Petroleum, ticker symbol OXY. We can see 2023 it was down 4%, trading towards the mid to lower end of the 52-week range, and we can see here a very small yield in comparison to the competitors at 1.21%. If you've been holding this over the last 10 years, well, likewise, to the majority of these companies, you would be down, and this is around 33%. We see the all-time highs a long time ago, nearly 10 years at around $100. So, dividend safety, 60, borderline safe, 52 billion. It is a large cap company. When we analyze those recessionary metrics, increased during the last recession, below average growth of 42% negative, but again, significantly outperformed the S&P with a negative 23% return. Now, dividend growth, well, they increased 22% just a few weeks ago. However, negative 30 over the last 3 years and 0% over the last 20. As we can see here, they did do 2 cuts in 2019 and 2020, although they did increase it just a few weeks ago to 22%. So let's take a look at dividend yield theory. We can see here a sign of undervaluation for Occidental Petroleum, 1.47 versus 0.88. Forward PE, however, slightly different, higher than the 5-year average at 13.1 versus 9.7, and we can see it is also higher than the energy sector PE at 11.8. So let's take a look at dividend, or in fact free cash flow payout, the dividends that are paid out by Occidental Petroleum. We do see in actual fact 2022 at 4%, 2023 at 9%, so we do understand why we saw that very high dividend growth. And I would expect, given the fact that 2024 is expected around 12%, to see another nice double-digit dividend growth for Occidental Petroleum. Free cash flow, well, $6 in 2013, $13 in 2022. It has more than doubled. But again, note the inconsistencies year on year. And also very important to note, 2023, it is expected to nearly half to 759. Sales growth, again, very typical, the cyclicality, so there's not much to mention there. Total sales, well, it's gone from 20 billion to 36.6 billion, but again, do note 2023 it is expected to drop, and unlike the other ones we have looked at, they do quite a lot of share issuances, diluting your position from 805 million in 2013 to 1 billion in 2022. ROIC then, positive to note, the last year has been very strong at 24%. 2023 is expected to close out at around 13%. So again, very positive, but something to keep an eye on. Again, as we've seen in previous years, it has come into negative territory. Operating margin, free cash flow margin, the last few years, for the majority, as we are going through these companies, we can see the trend. The last few years have been very strong post-COVID for these oil and gas companies, very high metrics, and Occidental is very similar, both on the operating and free cash flow margin. When we look at the net debt to EBITDA, 0.88 in 2022, 2023 expected to climb slightly higher, but still some breathing room to that 1.5 maximum we look for. So let's jump into OXY's stock valuation model. And as always, if you enjoy the content, values being provided, smash that like button and hit the subscribe and bell button so you can be continually notified of these videos as they drop. So at a 10% margin of safety, it is around $1 and a bit shy. So you're getting around a 10% margin of safety or thereabouts. one of those that we have reviewed so far with the smallest margin of safety. In terms of Wall Street and what they believe, well, they see around 15% upside to Occidental Petroleum. So in conclusion, for OXY ticker symbol, we do see one of Warren Buffett's favorites coming in at around a margin of safety of just around that 10% mark based on our estimates and judgments, with Wall Street expecting around 15% upside over the next 12 months. Moving on to the fourth company, we have CVX Chevron Corporation. Again, 2023 down 16%. Again, trading towards the mid to lower end of the 52-week range with a yield of just over 4%. If you've been holding this over the last 10 years, you'd be up 20%. And as we can see, it hit its all-time high towards the back end of last year at around $186. So let's take a look. Dividend safety score very safe at 90. Market cap $281 billion, a mega cap company. Now, when we look at those recessionary metrics, well, they increased the dividend during the last recession, below average growth, but again, significantly outperformed the S&P with a negative 34% return. Dividend growth, one of the better, more consistent increases, 6.3% last year, and in fact, we should be expecting an increase over the next few weeks. 6% over the last 5 years, 7% over the last 20 years. Very positive to see. I love that consistency. And two things to note, they're a dividend aristocrat. They've increased their dividends for the last 35 years, and they've been paying dividends for the last 111 years without a reduction. Lots to love. Now, in terms of dividend yield theory, we see reasonable valuation with the current yield pretty much the same as the 5-year average. However, note the forward PE is sitting at 10.5 below the 5-year average of 12.8. Again, energy sector PE is slightly higher at 11.8. Now, looking at that free cash flow payout, a very similar story to the other oil and gas companies. The last 2 years below 60%. 2023, 55%, 24 expected 43%. So that is fairly positive. We should again be expecting a nice increase over the next few weeks. Negative 1.56 on the free cash flow per share, 19.5 in 2022. It has been increasing over the last 10 years. Again, inconsistency, volatile. These are a lot of things which are very common in this industry, as you should have noted by all these metrics we have run through. Again, very same story on the sales growth. And when we look at it numerically, well, 212 billion in 2013, 236 in 2022. Shares outstanding, again, it hasn't really moved on a net basis. 1.93 billion in 2013, 1.94 in 2022. Now, when we look at the ROIC, 21% in 2022, 15% in 2023. It has decreased, something just to keep an eye on as we move into 2024. Operating margin, again, it does follow, again, the similar trends that we've seen for the other companies, so there isn't much that I will point out here. And when we look at the net debt to EBITDA, well, 0.17 in 22, 0.31 expected in 2023. So this is one of the better oil and gas companies with a very strong, not only dividend safety score at 90, but also a very healthy balance sheet. Now, in terms of the valuation for CVX, let's jump straight into the valuation model. And as always, if you do want to grab a copy of this model, you can click on the pinned comment below, run through whether it's these companies you want to run through, others on your watch list, or even just your own in your own portfolio. Margin of safety then with an intrinsic value of $180. At 10%, it's a buy up to 162 based on our estimates and judgments. At 15%, near enough the current trading price. And 20% quite a while away. So we do believe it's currently sitting at a 15% margin of safety. In terms of Wall Street and what they forecast, pretty much over the next 12 months, they do expect it to hit around our intrinsic value. So they see around 20% upside. So in conclusion, for Chevron Corporation, we see around a 15% margin of safety, with Wall Street expecting around 20% upside over the next 12 months. We then move on to the fifth and by no means the worst option. We have Shell PLC. Year to date, or in fact 2023, they were up 16%. They are trading towards the mid to upper end of the 52-week range with a yield of just over 4%. Over the last 10 years, well, we can see if we move that in fact to the last 5 years from January 2022 at $51, they are up over the period. We do see it moving in the right direction, which is positive to see, but there have been lots of times where this stock has dipped, so it may be one just to consider when it does have a significant dip over the next few months or even over the next few years. Dividend safety score then, one of the lowest at 45, borderline safe, 214 billion. It is a mega cap company. In terms of recessionary metrics, well, they maintained the dividend during the last recession, below average growth, and still outperformed the S&P with a negative 42% return. In terms of dividend growth, well, double-digit increase in July of 23 at 15%, although over the last 5 years and the last 3 years we see negative growth on average. Not the greatest sign if you are a shareholder, and they've been increasing their dividends for the last 2 years. Now, dividend yield theory, we can see reasonable valuation, 4.02 versus the 5-year average of 4.08, and we see the forward PE bang in line with the 5-year average of 8.8. Now, when we compare it to the sector PE, it is significantly lower at 8.8 versus Energy's 11.8. Now, taking a look at the free cash flow payout, interesting to see the last 4 years or 3 years and fourth year, if you include 2023, around the 20 to 30% mark. So that is positive. We would like to see a very strong dividend growth increase in 2024. Now, when we take a look at the free cash flow payout, it has increased again over the last 10 years. It isn't consistent, but again, it is just something to know with this company. If we were looking at a tech company, for example, and there weren't lots of increases year on year, then that would be something to flag. But for Shell in the oil and gas industry, this isn't something to flag, but mere to understand about the industry itself. Again, similar story here on the sales growth. Numerically then, 451 billion in 2013, 381 in 2022. Shares outstanding, 6.29 in 2013, 7.41 in 2022. So they have done a net share issuance, so they have diluted your position fairly considerably over the last 10 years. Return on invested capital, 22% in 2022, expected roughly the same in 2023. So again, something just to keep an eye on given the essential history where it has gone down well below that 10%. But over the last few years, it does look fairly positive. Operating margin, free cash flow margin, again, nothing really much to say here. It is something that is essentially the same for the other companies we have analysed. Net debt to EBITDA, again, a fairly strong balance sheet and dividend safety at 0.67, 0.72 in 2023. So we did see a fairly low dividend safety score, but based on the information that we have at the moment, I do believe that dividend continues to be safe. So finally, running it through the valuation model, as always, the intrinsic value is just the average of these models. It comes to $80, with a current price of $65.85. A 10% margin of safety means a buy at $72. At 15%, a buy up to $68, and at 20%, around $1 or so away. So we believe it has around a 20% margin of safety based on the current trading value. With Wall Street, as we can see, they believe the share price over the next 12 months to hit around $74. So we can see they see around 15% upside. So in conclusion, for Shell Corporation, we see around a 15 to 20% margin of safety, with Wall Street seeing around 15 to 20% upside over the next 12 months. As always, do let me know your thoughts in the comments below. Have you been adding any of these undervalued oil stocks, or do you believe for whatever reason that these are in fact overvalued? Do let us know your thoughts in the comments below. However, based on the information that we have gone through, my personal view is that they do look to be undervalued as an industry as a whole. We have a lot of articles, in fact, giving their top picks, and we do see the likes of Chevron Corporation coming a lot, Exxon Mobil as well, and those are probably the two, in my opinion, that do look to be the strongest in terms of dividend safety as well as the balance sheet strength. But as always, I'm keen to hear what you think. Don't forget to smash that like button if you've enjoyed the content. Hit the subscribe and bell button as always to be continually notified, and let me know if you enjoy me running through some of the top stocks within each industry, within each sector, and I can bring out more content very similar. Don't forget, click on that pinned comment below, grab a copy of the valuation model, run your own companies to get your own intrinsic value and acceptable buy price of companies in your portfolio based on your own estimates and judgments. As always, Happy New Year, have a great day, and catch you all on the next episode.